we have our final panel session of the day. I want to welcome to the stage everyone who's going to be talking about opportunities in private debt. So here today we have Chris Flavell from AraCapital, Ulrika Lobo, Director of Blue River Finance, Jeff Law from Commencer Capital, and Troy Harper from Aviation Capital.
I think we'll start with a quick roundtable introduction of who we are and which area of private debt that we come from. I'll kick things off. I'm Ulrika and I manage a first mortgage fund. We operate as a private lender in the market. We provide property-backed loans to businesses for various commercial purposes.
Hi, I'm Chris Flavell. I'm a managing partner, previously a director at AraCapital, but we've launched on the 1st of July a new company called Second Sphere Partners. So we're a partnership looking at capital raising for both companies. So we look at both debt and equity capital for growth companies.
Hi, I've got that right. Hi, Troy Harper. I'm with a director of Aviator Capital. We specialise mainly in mortgage finance, development finance to kind of small mid-tier companies.
I'm Jeff Law. I'm a fund manager at Commencer Capital. We're predominantly actually an equity fund. We run a VC fund for emerging companies. I do come from a debt background in my previous life, and in the current role, Commencer does originate debt and credit opportunities for a number of our distribution partners.
Great. So we've got our first question. In recent memory, investment has been relatively easy to come by due to the strong bull market we've been in. Now, as investment is drying up and becoming scarce, are you able to introduce us to the private debt space and your experience in it?
There's no doubt that as capital is more difficult to get for growth companies and any company really, just as you can see with the decline in the general market, share market, that new forms of capital are going to be critical to accessing and pushing out the requirements for any form of growth. And the interesting thing is just seeing the emergence of, for example, new fintechs who are doing revenue-based financing. So there is element finance, tractor finance. There's a whole new suite of fintechs that are coming out that are doing revenue-based financing. And the new funds, number of new credit funds that are coming to market through such as Commencer Capital's Jeff, but there is Metrics, there's a whole raft of new debt opportunities that are going to be there and looking to provide those for private companies.
Yeah, sure. And I think it's worth noting as well that debt is not a homogenous space. You know, we get umbrellaed under private debt, but there's many different kinds of private debt. You've got private debt that's business loans where we're not dealing with any assets. It's generally unsecured financing. They're higher risk, but they've got a higher return. You've got asset-backed funding, vehicles, equipment, and property. They have varying rates of return as well, depending on the quality of the assets that they're being secured by. And you've got bonds too.
Yeah. Right.
Does anyone else have anything to add to a bit more information about the private debt space and their experience in it?
Sure, I'll jump in. Look, it's interesting. So we, again, in the construction space, you're seeing impacts of things that have seeded for quite some time. You've had, project lead times long, so you'll lock in financing. We're seeing the wealth of kind of increases in inflation and cost pricing. You're seeing projects being cancelled. But at the same stage, you also had a trend of particularly private lenders reducing their rates of return almost to directly compete with banks and things who'd retreated from the space. So if you're looking at, say, construction debt, that's come down from, maybe 8% to, if it was a good project, 5%. It's interesting. So some of these poor projects being washed out, you're seeing opportunities there, which were the opportunities in many respects to start with, which were work with quality tenants. But the demand for project financing is coming back because I think you'll see, particularly as rates rise, you'll see reticence from larger lenders again to lend in certain spaces or to certain people or without certain, covenants. So, certainly in our space, in what we're seeing with other businesses, the demand from people for project financing coming private again is increasing quite significantly.
And the only thing I'd add, just a slightly different space that we operate in. We're probably more, not so much in the project space, but more in the highly structured, high-yielding corporate space. So some of the types of debt you talked about, but also that venture debt space where that sort of crosses over as well. We're definitely seeing opportunities there for increased debt. And some of it's for companies that haven't had debt before. For others, it's a chance to refinance some facilities they had in place previously that are now looking increasingly out of market for good and bad reasons. Some of them had equity raising covenants in there that are just very hard to meet and very dilutive in this market. So we're seeing opportunities to step in, take out some of those existing facilities, replace them with slightly longer term, not covenant light, but sort of restructured facilities. We think makes a lot of sense for some of these startups.
Great. So question 2. Is it feasible for an investor to begin lending privately, and how does it compare to providing their capital to an investment firm for a fixed return?
There are several forms of, as there is syndicated deals for equity, there's syndicated deals for debt, but I think generally the highest growth sector of the market is funds, and there seems to be an emergence of a large number of debt funds and credit funds, which is a good opportunity for the market to get higher yields, and as long as appropriate due diligence is done around the manager and what they're investing in, then those funds should be able to give superior returns, taking into account the risks that are in place. So going into a single deal is risky, going into a fund is risky unless you do due diligence on the manager and the depth of experience they've had. But both of those are, I think, legitimate strategies in the current market where rates are going up. And the sorts of rates you should be looking at now, it depends on the underlying asset base, but we see for growth companies when we're putting deals together, for the first debt that a company takes on board, a company quite often is willing to take on debt in the form of a convertible note or something like that at up to 10% or 15 high teens, which is far less dilutive than going out and raising equity at 25%, for example. So we put lots of names around them, but there are different forms of blended debt and debt and equity. There are venture debt funds, so parties like Partners for Growth or One Ventures or several of the large venture debt funds, and they provide a large chunk of debt and take a warrant, so an equity option on that as well, and that can defer or give you a longer runway before you need to go and do your next equity raise.
Yep, I also think, a lot of investors, particularly in property lending, do ask me that question, what's stopping me from going out and writing a deal myself instead of investing with a fund? And I think it's an interesting question because, yes, your first deal might be great because you've got something across the table, but is it going to be repeatable? Are you going to be able to do it over and over again? And the other thing is the experience if it doesn't go according to plan. How are you going to monitor the different aspects that might speak to, any warning signs or red flags that have come up throughout the loan, and how are you going to manage the downstream effect of that? So I would say that, for investors, when they're going about it on their own, it's a matter of weighing up all the options. How much experience do you have, moving to foreclose on a property or managing legal teams and negotiating costs and processes involved, or even managing difficult borrowers and getting people to communicate with you, because that's something an investment firm takes away from your plate and gives you the return at the end of the day by managing all of these moving parts and these fluctuations throughout the whole deal. So I would say, yes, for a very experienced investor, it is possible to do this, but is it going to be repeatable? If you're not running it as a business, it's probably going to be less likely to have a success after success story. You might have one great success story, and that's great, but I think for repeatable outcomes and for managing various situations, it's great to go with an investment firm for that fixed return.
I, I think that's right, and I think also too the vector at which your client base comes from you when it's a one-off is really important. I mean, we started private lending out of our business before it was even really private lending, and you'd have friends who say, listen, I need money for this or I need money for that. And that's when you're a one-off. That's kind of where you get some of these deals from. And so then you end up in situations where, exactly as you've outlined, are you taking somebody's house? Are you wandering into a friend's place and collecting the collateral that they promised you? Those type of things. It gets sticky quickly, and you know, unless you're out there sourcing, assessing deals as an investor, not as a friend or a referee. I think that's where you can potentially start to get into trouble. I think you actually have to treat it very clearly like an investment, dispassionate, and ideally your client base are not people that are known to you.
Yeah, I've never got much to add to that, other than maybe access. You get a lot more access to transactions via going through a fund who's aggregating a pool of investors. As a lender, if you're putting out a smaller amount of money, it's hard to find transactions or companies that want to go through the cumbersome process of documenting a transaction for a smaller amount. So you get access to a larger number of deals.
What returns would an investor expect when lending in a private debt setting, and what are the risks associated with it?
How long is that piece of string?
Yeah. It depends on the situation. So obviously, if you're going in as an individual into an individual deal, you can have a very wide set of returns. Everywhere from, if you've got some options for equity upside, you can have several times your money compared and lose it completely. So it depends on the asset base that's being lent, how well it's been securitized, how well the documentation is, the process for working through any bad debts or deals that go wrong. So that's why you look at the track record of the fund manager if you're going to invest through a fund, or and look at the underlying assets that you know and understand and you're comfortable with.
And remember too that we don't go out as investors and say, hey, I want to get X. The pricing of debt in a lending scenario is meant to be a reflection of the risk. And so the higher the return, the more risky the loan is. So I think you have to kind of choose your return not based on what you want to get, but based on the amount of risk that you're prepared to adopt. And I think that kind of gets missed sometimes in the equation, because everyone's out there for the search for yield. But you can get to a certain point where you're taking on risks that you haven't acknowledged through the process for a payment which may well stop. So it comes down to that as well.
Yeah, and maybe just to expand a little bit on how we operate. I mentioned we have distribution partners, and they have access to a whole wide range of high net worth investors. So rather than having a single fund that they tip people's money into a range of opportunities, they'll approach that investor base every time there's a new opportunity. So they'll be aggregated with other investors who want to do those deals. We've arranged facilities for them as low as a straight 8% yield with no equity upside, and as high as 18% interest with warrants attached to it that provide quite a significant amount of equity upside. So a vast difference, obviously, and that's that additional risk that's been captured by those returns can come from a new sector, a lack of revenue, a new product, a different jurisdiction, a range of different things. So yeah, very, very diverse range out there. Even we cap out at that sort of high single digits. We're not looking at anything lower yielding than that, but there's obviously a world of loans that sit beneath that as well, that other funds are looking at and other banks are looking at.
I agree with Chris as well when he said that there's management risk and you've got to really look at the fund manager and assess that. I think that's the biggest risk. You've also got credit risk with different types of loans, depending on the security behind them and the structure. That means, are they going to be able to be repaid on time and without any losses? And if it does go over time, how are you going to recover any fees and charges and overdue interest that might have accumulated on that facility? I also think that there is a general expectation of where return lies. Generally, if you're going to a retail fund that does mortgage-backed securities, you're looking at 4 to 5% per annum. Private funds are usually 6% plus. If you're looking at second mortgage funds, you're starting at 12% per annum there. And then unsecured cash flow finance is generally 20% plus. But I have seen some, operators also charging cheaply for that, depending on the guarantees and the structures, at about 15% per annum too. But traditionally, I've seen more likely 24% per annum for unsecured business loans. So are there any little-known benefits of operating in this space rather than in more traditional markets? Little-known benefits. I imagine that means something that not everyone knows, but that we know. I have something to say on this one. I think a little-known benefit is how inefficient the private lending space can be, particularly in property lending. I made a comment on this in my presentation where you can charge 9% on a deal where someone else might offer 6% on the same deal. It's the same risk profile, the same structure, but it's a very asymmetric industry. It comes down to the comfort of the lender and also, what they can negotiate with the borrower more so than a perfect, efficient market where you can compare rates on a platform or in a market space, a marketplace.
I'd agree with that. The interesting thing for me is just to look at the different forms of new investment that are starting to come out, as I said before, just these new cash flow lending and other specialist areas where, for example, for a SaaS company where somebody is going in and just willing to take over managed service contracts or software sales contracts, and they will pay out 12 months revenue or something like that. And these sorts of structures and the ability to do them very quickly and creatively, I think, are interesting. But the rates of interest are incredibly high. They tend to be, in terms of what's in the marketplace at the moment, in the order of sort of high teens or 20%. But when you compare it to the cost of equity and you compare the speed of execution and what that could mean to signing up a new large contract and what that can mean to a growth company, that's actually a very valid thing for them to do and basically can help them multiply their valuation X times because those sorts of companies are valued on a revenue multiple basis. So these are the sorts of individual pools, I think, of opportunities that are there if you know and understand those sorts of markets.
That's correct. I mean, we find the same in property. I think mispricing of debt is rife, and that's probably the little-known secret. Everyone has this view that, particularly if you go to a bank, that they're these enormous organisations that are all-knowing. They're not. There's an ecosystem that exists, which is what we're in, very, very happily feeding very profitably off what they say no to. So it's refreshing to be able to make those decisions and actually assess something based on its merits without having the weight of an organisational position or an organisational strategy which may be out of kilter with what's actually happening in the market that you have to adhere to.
Perhaps just one last benefit that you may all be aware of, but certainly a lot of the deals and most of the deals we will structure will be, rather than having a fixed coupon, there'll be a link to BBSY or BBSW plus a margin, so you're getting that protection against rising rates, which can be quite useful in this sort of market.
For our founders here, what's the process to access private debt, and how long does the process typically take from inquiry to accessing the capital?
Specifically for founders and early stage companies, the big question is how soon can you get debt and how soon can the company take debt on board without a personal guarantee, without you actually putting your own assets at risk. And that's a tough question. And sometimes, the risk that founders take on board is too much, and that's what leads to some burning out. And probably that's where the importance of having a good corporate advisor makes sense. So a gentle plug for getting as much advice as you can from advisors and taking that view before you go to that step. But then obviously taking debt on board is going to be cheaper than taking equity on board, and you need to always be looking at the next raise, which is, of course, why we're all here at Wholesale Investor.
I think it's also interesting. A lot of founders don't know what they don't know when it comes to options that are available in the market. It's a space that's being innovated all the time. There are different debt options, different players, different pricing across the board. I think the best thing to do is to speak to a broker that understands the space and understands your business structure, so they can point you to the best way to structure the debt that's going to be good, not just for controlling your business and managing the lender, but also from a price perspective.
And it's a document-driven business when it comes to actually, compliance and getting the loan put together. So the quicker, particularly in the property space, the quicker that you're able to, and it gets back to your point of saying using the right advisors, using the right brokers, the quicker you can put all of the information required into a format which is easily accessible, can be verified, and then put into the legal documents and documented, that really kind of drives just how long it takes to actually get your loan complete. And so, some people are really organised, have done the process before, they know it might be a couple of weeks, and you'll have people, we've seen brokers who, 6, 8, 10 weeks later, you're still asking them to put the same things together. So, that's the sort of thing that you want to avoid, but it really depends on, in many respects, how well you're advised.
Yeah, on the time it takes to put these things together, absent using a broker, in a bizarre way, it's the larger, lower yielding deals that take longer. Because the lender is going to take longer to get comfortable with the business that they're actually backing or the project that they're backing. There's a lot more diligence to be done, if there's a lot more history to get through. If it's a relatively newer company and they're giving up more for it, there's a much higher risk involved, there's probably less diligence to be done, and those deals can actually be done a little quicker. So it's a little bit perverse the way that might work. We certainly aim to get through deals from start to finish in sort of 6 to 8 weeks. But yeah, it can be very different for different companies.
I have a spicy question. It is, where does everyone think interest rates are going to be in 3 months and then in 1 year's time? Does anyone want to go first? Stick their neck out.
What we 6%, I think, inflation was the print today, year on year, another 1.8, so that'll be another 50 basis points, I would say, out of that. Could be another that again, I would have thought. I think there's still room to go from where we are now. But I'm no economist.
Mm-hmm.
Look, there was an opinion put out by, and I'll borrow somebody else's opinion for a bit, but it's mine too. Macquarie, one of their leading guys, put out an opinion saying that we'll see rapid rises and then we'll get to a point at which it will either stabilise. Because there's a lag with all of these things, the old economist description that you're driving the car, but looking in the rearview mirror, not out of the windscreen, because you're checking what's happened. You're not in real time what's happening going forwards. I think it's very true. You're going to find there's going to be a lag. You'll see increases. I think you're right. I think we've got another 50 basis point increase coming, possibly at least another 50 coming after that, maybe in 2 rises rather than one big one. But at a certain point, the other factor in all of this is that you've got the biggest users of bank refinance have been fixed rate loans. And most of the $120 billion finance facility that the federal government gave to banks during COVID to keep them afloat was what had went out and funded fixed rate loans. And that's why you've seen fixed rate loans so cheap. Historically, they've never been that cheap. It's because they were backing it with the money they were getting from the Fed, and then they were offering a fixed term. So that all expires 2024. So you'll really start to see pain in the mortgage market the end of 2023 coming into 2024. So I suspect at that stage we'll probably see some decrease, an adjustment down in the rate, because they may have got the settings too high too quick. And bearing in mind that the inflation we've got is exogenous. Everyone says, there's too much demand in the system. Yes, partly, but most of it, shipping containers had gone from, gone up 4-fold during COVID, possibly more in cases. You simply couldn't get, people were saying, I will pay you to put my container on first rather than take what you've already contracted. So that a lot of that inflation was exogenous. It wasn't driven by demand. It was driven by supply chain problems and people trying to complete things. So I think there's a fair chance that they'll overshoot, and we may well see an adjustment down, late 2023.
Yep. I think that you're right. There were a lot of supply chain issues that have led to our expectations of where inflation is going to be, along with, the misguidance almost of the forward guidance of the RBA saying the rates were going to stay the same until 2024. Everyone locked in their contracts, but now, with having that cash rate so low, that has almost been an impossible promise. I don't think he could have made that promise just because of the entanglement between international markets and central bank objectives. The interest rate was always going to go up, and depending on international conditions, it would have been before 2024. There's just no way you could keep it that low for that long without affecting the Australian dollar and then having many, many downstream effects and issues for inflation. So, the prediction is that inflation is going to be at about 3.5%. I think with the expectation that we're going to have many more rate rises moving forward, that rapid increase of inflation is actually almost going to create an overreaction in the market in the short to medium term before it then stabilizes. So I think in 3 months, Troy's right. There's going to be probably 2 more 50 basis points increases, and then there might be steady increases after that based on how the economy has responded to it. And in 1 year's time, we're in our lowest cash rate environment ever. It's unprecedented. There were times when having 5%, 6% interest rates was normal. Having 8%, 9% interest rates was just normal from the banks. And I think we might see some of those 7s and 8s come into play next year, but I hope not.
I suspect we will. I think the artificiality that we had when we had all of the reserve banks around the world pumping extra money into the economies, and the amount of money they pumped in led to significant asset price inflation, significantly lower interest rates than we'd seen in decades. And so what you were describing is actually more normal. I've lived through interest rates, up in the 20s, mortgage rates in the high teens, and I don't expect that to happen again. But I do expect, rates to normalise, and that will have the interesting thing for founders and for outlook for those who've participated in the markets over the last couple of years, is that's going to lead to a significant change in valuation bases for operational companies. The numbers that have been out there for a long time, and you can see it in public markets, you can see what's happened to all of the high growth companies, how hard they've been hit. And what that means it's not about the cost of the capital, it's not about the cost of interest, it's actually about access to capital. So for growth companies and for young companies, it's about how do we actually go about getting capital now, be that debt capital or guarantee, with using personal guarantees or small equity raises, and how do we shape that to what our future capital requirements are to meet our growth targets, to be able to meet our business building scenario that we're looking for the new unicorn that we're trying to put together.
Well, I think, does anyone have anything else they'd like to add before we wrap everything up? Great. I think we'll wrap it up here. We've come to the end of our session. Thank you to all the panelists for sharing your thoughts, and I hope everyone has something that they can take away and make decisions on the back of. If you'd like to know more, please come and grab one of us afterwards. We'd be more than happy to chat to you. Thank you.